Direct investment is straightforward. You take your capital, find a publicly traded company you believe in, say the consumer tech giant that built this classic Macintosh computer, and you buy a fraction of its shares. You own a direct piece of Apple. But what if your strategy requires buying a fraction of 500 different companies at exactly the same time? Or maybe you want to short foreign currencies, or structure your returns to strictly comply with Islamic financial law. For most, the logistics are prohibitive. Building a diversified 30-company portfolio with just $3,000 can result in 10% of that capital being cannibalized by minimum commission fees before the first trade is even placed. Between high entry costs and the need for institutional legal infrastructure, the most sophisticated strategies remain out of reach for the individual. The solution is a collective investment scheme, or CIS. Instead of buying assets individually, a large number of investors pool their capital together into a single, unified vehicle managed by professionals. By consolidating thousands of small accounts, retail investors bypass the restrictions placed on individuals. Their pooled money operates with the mass and buying power of a major institution, allowing them to participate in markets that were previously inaccessible. In an open-ended fund, when an investor adds money, the fund expands its capital base, creating new shares on demand. The price of these shares is the net asset value, or NAV, the portfolio's total market value minus liabilities, divided by total shares. Closed-ended investment companies take a different approach. Instead of expanding and contracting, they issue a fixed number of shares during an initial public offering. After that, those shares trade on a stock exchange exactly like a normal corporate stock. Because close-ended shares trade on the open market, their price is driven entirely by supply and demand. If the market is pessimistic, the share price drops below the value of its underlying assets, trading at a discount to its NAV. If an investor needs maximum agility, they use exchange-traded funds, or ETFs, and exchange-traded commodities, known as ETCs. These vehicles offer continuous real-time pricing, allowing them to be bought and sold instantly throughout the trading day. An ETC captures the price performance of an asset like gold without buying bullion or renting secure vaults like this one to store it. The fund handles the physical reality. The investor simply trades the shares. This table breaks down how ETFs actually track their target markets. While some physically buy underlying stocks, the bottom row shows others use synthetic replication. They don't buy physical assets, instead entering derivative contracts, like swap agreements, to mimic index returns. By wrapping vast portfolios and heady physical commodities into standardized, tradable shares, these structures convert illiquid markets into highly liquid fractions for retail investors. Some investors want highly specific outcomes, like participating in stock market growth while ensuring they won't lose their initial capital if the market crashes. That demand created structured products, splitting your capital in two. The bulk buys a zero-coupon bond at a discount to return your original principal. The leftover fraction buys a call option on an index, capturing the market's upside. On the aggressive end of the risk spectrum are hedge funds. Established as unauthorized, unregulated schemes, access is restricted to wealthy individuals and institutions. In exchange, the managers use heavy borrowing and short selling to generate positive returns in any market condition. One specific strategy is global macro, where managers look for large-scale global themes and take highly concentrated bets on broad indices or currencies. A classic example is shorting the British pound, effectively placing a massive trade directly against the Bank of England. These directional trades were historically orchestrated by managers like George Soros, whose fund famously broke the Bank of England in 1992 using exactly this strategy. Financial engineering is also used to navigate strict ethical and religious barriers. Under Islamic Sharia law, earning or paying interest, known as riba, is strictly forbidden, ruling out traditional bond investments. The solution is a sukuk, an Islamic risk-sharing bond. In an ijara structure, a tangible asset is transferred to a special-purpose vehicle, which leases it back. Instead of prohibited interest, the vehicle distributes rent to the certificate holders. Through precise financial engineering, institutional capital can now flow into spaces that were previously restricted by high complexity, aggressive risk profiles, or strict religious doctrine. Access to these systems is never free. These vehicles require fund managers, technology, and administration, resulting in layers of costs, from initial entry charges to annual management charges and ongoing charge figures. Over time, these fees can significantly erode the actual returns you realize. There are also structural risks. When you buy a synthetic ETF, you don't own the underlying stocks. Your return depends entirely on swap agreements with third-party institutions. If that counterparty fails to deliver on its contract, the fund suffers the loss. Illiquidity is another trade-off. In vehicles like private equity and certain hedge funds, you cannot simply sell your shares when the market drops. Your capital is often legally locked in for months or years, regardless of broader economic conditions. Even products designed for safety carry hidden dangers. Structured capital at risk products, or SCARPs, offer high returns with partial capital protection, but they are often off-balance sheet items for the issuing bank. If that institution goes insolvent, your investment likely falls outside standard deposit protection schemes. Collective investment vehicles have effectively dissolved the boundaries between the retail investor and the global institutional market. But as these barriers vanish, the investor inherits a new requirement. They must understand the mechanical trade-offs of the engine they've chosen to ride.